Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending December 15th, 2017. Well, we're rounding out the year 2017, and what a year it's been for us and for just about any trader, to be honest. If you've been in the markets and you've had the courage to stay long and not listen to a lot of bearish pundits out there, you've probably had a very good year. For our trader user group, as we round out 2017, we've had a great year ever since the beginning of this year. Especially for those of you that have been following us on my weekly roundup, and clearly for our members, I've been saying buy the dip all year long. So in many respects, this year was a relatively easy trading year for those that have stayed long. There hasn't been very many pullbacks. In fact, we haven't had a 3% pullback all year. We haven't had a 5% pullback since 2016. The Dow has seen 69 record closing all-time highs this year for 2017. 69 of them. It is one less than the all-time record. And we go back to 1995 when we had the go-go 90s. If our bull market continues without a 20% drawdown pullback, which would be a bear market, if this continues through the summer months of 2019, then we will set an all-time record for the longest bull market in the history of the markets. Right now, I think we're number 2. The 1990s is the only time that we've had a longer stretch before having a 20% pullback. Now, the other thing that we're getting is that we're getting this synchronized global growth all over, from the Asia Pacific area, Japan, South Korea, the Korean Peninsula, China, over into the European area with the ECB, Great Britain, and here in the United States. So we've had this, excuse me, we've had this global growth story all year long. Synchronized. Everybody is doing very well. Corporate earnings are up as well, double digit this year. In fact, the New York Fed, which is a regional Fed, has estimated Q4 GDP to come in at almost 3.9%. And I remember we were running steady 1.5 to 2.1% for about 5 or 6 years. No one thought we could get above 2.75 or 3%. And now if we have that number in Q3 of this year, that would be 3 quarters in a row that we've surpassed 3%. All of this due to less regulation. And keep in mind, less regulation. We got this potential tax package coming through. And the optimism for consumer sentiment, as well as small business sentiment, is through the roof. So how long can this last? Well, it lasts as long as it lasts, right? I mean, that's not really, I know that's not the answer you want to hear, but that's the truth. I believe as we go into 2018, it is going to be a little bit more of a challenging year. We will see a little bit more volatility come back into play because the bar has been raised for quarterly earnings. Even though we've got, I would say, elevated, not quite very rich valuations, but we've got valuations across the board here in the U.S. equity market where they've got to perform for each quarterly earnings cycle. And I believe that now the bar is very high. So if you have some misses, we have a tendency to pull back more than if we have beats. In fact, this year, in the latter half of this year, all companies that have missed, every company that's missed their earnings have been punished on average on a percentage basis 2 or 3 times more than those that have beat earnings, where they go up in price, but on a percentage basis a lot less. So that tells me that we're getting at parity as far as no more valuations unless earnings keep growing. I believe next year we're going to see a cessation of some of these huge, strong corporate earnings growth just because of the law of the numbers. This year in 2017, we were comparing earnings quarter over quarter, quarter over year, and the prior year in 2016, earnings were flat to sometimes slightly below the zero line. So that made 2017 a Goldilocks year. low inflation, low unemployment, low interest rates, high consumer sentiment, high small business, mid business sentiment, and a lot less regulation brought by the Trump administration. And whether you like his policies or not, doesn't really matter what you like or don't like. What we do in our user group is we trade what the markets give us. And right now, it's serving up sweet apple pie with ice cream if you like that stuff. Or if you're a health nut, maybe a bowl of kale. I don't know how anybody could eat that stuff. But anyway, that's kind of where we're sitting right now in the markets. If we take a quick run through as we wind down the end of this year, just as a reminder, be on the lookout early next week. We're going to be doing a special holiday offer for our user group. We've already done probably about 15, maybe 20 different 20-minute videos for our option masters. And if you're not part of it, I highly encourage you to come in and check it out. So be on the lookout for that, as well as a special holiday offer for our annual user group. It's going to be one that you don't want to miss. We've had a great year this year, and I think next year it's going to be even better. Not that the markets are going to blast like they did in 2017, but it's going to offer up some great opportunities in the commodity market for us, and it's going to offer up some wonderful opportunities in currencies and then in the equities. So let's take a look real quick at what I'm seeing right now. What I've got on the screen is the daily chart of the S&P 500 E-mini futures. And you can see I have had this chart on here really since Q4 of last year. We've been staying in this channel all the way up. I mean, it's just a tight pattern all the way up. You can see on the MACD starting in the summer, there has been absolutely no bearish divergence, none at all. In fact, going into the beginning of the year from December, the middle of December, early December of 2016 on, we've just had nothing here outside of one little hiccup at the beginning of the year. But outside of that, we've been north of this channel just a few times. Once in late February, early March, and then as we round out the year in December, we're coming into the end here. Now, based on the stats as we went into the beginning of December, if you remember what I said that odds are the markets will favor a 2.5% move up through the end of the year. When we hit the month of December 1st, 10% up. All right, so if we hit the month of December 1st, 10% up, and we did, we were well into the low teens at that time, low to mid teens, then we've got an 80% shot of finishing the year at a 2.5% move to the upside. Okay, so if you look at the December move, right, when we hit December right around 2640. All right, so if you take the 2640 times 2.5%, it puts you right around 2706. So I had said at the beginning of December, the odds favor us breaking 2700 by the end of the year. Okay, now we're at 2683.25, all-time highs that we made on this Friday. So we only have about another 20 points up over the next couple of weeks as we finish out the year just to hit the mean or the average of a December move. Okay. So the stats are still holding up. I don't see any divergences here that would suggest the market will pull back. And remember, the tax package, it looks like they've now got final approval, which is what gave the market its strong move higher on Friday. And should they get it signed, we could have it move up a little bit more and then kind of pause out and then pull back just a little bit as we go into the end of this year, beginning of January. So that's kind of how I'm seeing the markets here. So you can see the E-minis are doing very strong. If we look at the Russell, all right, which has been a little bit opposite, it had a strong move on Friday. Why? Because the Russell stands to gain the most on a tax package run. All right. It's also the one most susceptible to a tax package failure, meaning it doesn't get approved because it's small and mid cap. And for companies where most of their earnings are done onshore here in the U.S., they're going to be impacted the most by the tax package. Okay. So that's kind of what I'm seeing here, and that is reflected in this move here. So if they get the tax package through, we'll see the Russell move up, take out the all-time highs here, and approach the high 1500s, maybe even up to the 1600 area as we go through the end of the year. Okay. Now, for our members, I've been showing you guys the securities you want to trade if the tax package gets through, and the ones that you want to be long in. So we've had some good fortune with that. If we look at Nasdaq, which is mostly technology, you can see again on Friday we hit all-time highs, a little bit over 6,500. Now on Nasdaq, we're getting a little bit of a bearish divergence, so that suggests to me we may have a push higher and then just a little bit of a pullback consolidation mode down to around 6,400 area. Wouldn't surprise me to see that at all. And the Dow, which is, as I said, has had 69 all-time highs for this year. Look at this thing. It has just been on fire ever since the middle of November. You can just see this huge run up here. There is no bearish divergence, guys. Any dip right now is still going to be bought across all asset classes. Here are all indexes, and then of course, if we look at the VIX, it's back down again. It fell over a full point on Friday, and we're back down around the lows, which we've kind of been bouncing around for going all the way back to the beginning of the fourth quarter of this year. All right, so again, all things are still looking bullish right now. We look at bonds, and this has been tough for a lot of big traders, I know. Bonds, you would think with the interest rate hike, bonds would be going lower and interest rates higher. But we're getting a flattening of the yield curve, meaning the short-term rates, the 2-year, are going up at a much faster clip, interest rates, and the longer term are staying steady to slightly down, not much. And that tends to tighten the difference between the two, which gives us a flatter yield curve. And right now, I'm not concerned about it. But should the yield curve get below 25 basis points, then I'll start to get a little bit concerned. Okay. So that's kind of where we're sitting here with the bond market. We're still in my wide chop zone, which you can see the shaded zone here, which kind of goes up to about the low 154s down to around 152. So we've been in this chop here going all the way back to early November. So for the past 60 days, it's up, down, up, down. As we get up nearer this upward area here, you'll probably see it come back down again. Okay, now correlations are thrown off for the past 3 or 4 years in the bond market and the equity market. Traditionally, when equities go up, bonds go down and interest rates go up. But we've seen them both correlated where they both rise. And it's very rare that you see both of these move at the same pace in the same direction. But you do get these when you get a mismatch in the markets where you've got the Feds trying to manipulate the market like they have been over the past almost 10 years now. Now, 2018 is going to be key because we got a replacement for Yellen. In many respects, he's going to have a harder job than Yellen. All Yellen had to do was step up to the podium from Bernanke and keep the markets very dovish. There's really not much for her to do. I mean, I like Yellen. We call her Aunt B fondly, but I think she's just kind of much stayed in the same path. Stimulus, dovish, and then they just cut stimulus, but they just kind of kept their wording and their policy statements very dovish, which is what she did in her swan song interview, our press conference last week. So even though they raised the rates by 25 basis points, but our new Fed chair, Power Ranger Powell, what we're calling him, Power Ranger Powell, as he bellies up to the podium in March, as his first press conference, he's going to have a tougher go of it because he's got to shrink the U.S. balance sheet. And by that point, remember, there's still major stimulus in Japan. They're still doing some stimulus to some extent in China and across Great Britain and Europe. So there's stimulus everywhere. So as long as that's happening, the bond market is not going to roll over because we got a lot of money coming in from Japan and Europe into the bond market, which keeps the bonds propped up and interest rates suppressed. As soon as those guys and those other countries stop that process, you're going to see the bonds be a great short. We're going to be watching for it in our user group in 2018 going into 2019. But it's going to be a great opportunity for everybody. Look at the US dollar. You can see here that even though they've hiked the rates, going back to December the 11th, a week ago, the dollar's been falling down and the euro's been moving up. The dollar, I think, may be slightly near term higher, but longer term, it's going to disappoint. I think it's going to pull back, but short term, I think it's still subject to a little bit more of a a move higher. The British pound. As you know, we've been trading the British pound, and you can see on this chart here, this very wide channel, and we've been playing it both up and down. I'm waiting, hopefully, for it to get to the bottom of this channel, and I'll be willing to pick up some more longs. We shut down our pound trade about 4 weeks ago and took some profits out of it. Now we're looking for another re-entry point, but I do like it to the upside. And then, of course, the euro. I think 2018 is going to be the year of the euro. The minute Draghi, Super Mario, starts to talk about pulling in stimulus and stopping it, which they're scheduled to do in September, you're going to see the euro start to move higher against the dollar. Right now, it's still on an upward track, but we're in this wider consolidation pattern, much like we are with the dollar right now. I think both the dollar and the euro are trying to determine where is inflation going to go so that they can pick the direction and the way they want to play. The gold market is doing pretty much what I said it would do. It's very choppy, but I think we're still in a downward mode here on gold. And gold hates, absolutely hates higher interest rates, but it loves low inflation. But right now, I just think there's not a lot of impetus to be long gold or silver for that matter. Energy, well, for those in our secret trader, we've had a great year, really great. We just closed out this past week trade 22, number 22, where we've been profitable 22 out of 22 times in the gold market, in the energy market. And we're running about, I would say, 8 to 12% returns on a monthly basis on this thing. Okay, so that is more than double your money over an annual basis, and we've done 22 out of 22 of them. And we actually started it back over here, and then we've traded it to the downside and to the upside with our trade methodology, and it's worked out nicely. So we just put on another oil trade in the futures market, which, excuse me, so far the position structure is very sound, and it's starting to make some money for us, which we're looking to capitalize on as we go into the end of the year with the oil market. There is a big tug of war going on in oil right now between OPEC and the shale frackers here in the U.S. The IEA, the International Energy Association, is projecting more of a bearish tone, neutral to bearish tone for oil, and OPEC is projecting more of a neutral to bullish tone for oil. So that keeps both upward and downward pressure on it. After this big, huge move up here into OPEC from the end of August into the end of the year, we're digesting this big move here, and it'll take a little bit of time and a lot of chop to work our way through it. But anyway, it's been a good trade for us in Secret Trader. As I said before, if you're not in our Secret Trader with the end of the year coming up, I'd take advantage of our offer. Be on the lookout for it early next week because it'll be a good one for you to jump in. Now, for gasoline, we've got a nice trade going in gasoline. You can see here on this regression channel to the downside, we rode gas up and now we're riding it this way. Our position structure's got profits for us. My charting would indicate gas is going to finish up higher as we go into the springtime next year, which would go along with the seasonality of gas. But if we take out the 200 EMA and break below this regression channel and move lower, then that'll throw that out. But we're still, from a position structure standpoint, we can take our position and adjust it very nicely. but we've got profits in it, and we're playing this out. So we'll see how this one goes. Nat gas, well, there's just so much inventory in nat gas. Look at this. This is a daily chart. I mean, we've just fallen off a cliff. And quite frankly, I'd like to see it come a little bit lower here, and then it'll be very appealing to me for a interesting position structure for nat gas. Right now, though, not much to it. Excuse me. But it's just been very bearish. Now there's some other trades coming up in agriculture and in from corn, wheat, soybeans, and in the soft market. We've had some great trades in sugar and orange juice, and we're looking at those as well as potential trades or in coffee, cocoa. But that's kind of where we're sitting right now, guys. If you're again, for our members, I'll see you this Sunday night. For our non-members, again, be on the lookout for a special offer coming out for you. Otherwise, have a great weekend, everybody. Members, I'll see you this Sunday night. Take care, folks. Ciao.